Yes, please go.
Yes, hi there. Good afternoon. My name is Vanan from FIK International Kuala Lumpur. We've been around for the past 27 years organizing strategic business events and been working with Professor Lemon for the past 6, 7 months, trying to put together these two timely workshop. And Professor Damon came up with this idea to run these two masterclass session, which today will be the glimpse into operational risk and resilience for financial institution and our session. And followed by tomorrow, another session on third-party risk management. So our target audience, as we have discussed with Professor Damon, is mainly the compliance and the risk head of department in the risk. And therefore, this will give you all an overview about the workshop that we'll be running in Kuala Lumpur in the month of August. Professor Damon, you can start the session now.
Great. Thank you very much, and good afternoon, everyone, once again. Let me share the screen again. I hope you can see my screen. Someone keeps saying yes, no, please.
Yes.
Great. Thank you very much. So this afternoon, 1 hour masterclass is for operational risk management. In short, we also call it ORM, and operational resilience. Sometimes we call it OR. It's going to be a bit fast session. I'll ask some questions in between. Please attempt to participate. Those questions are not to test your knowledge, but to have some interaction. And if you have any questions, please feel free to type in, or at the end of the discussions, we have kept some time, then we will pick up all the questions that time. Quickly, about myself, I'll not go through all, but about 4 decades in the industry, about 2 decades in BCM resilience, operational resilience, organizational resilience, etc. I have been going across companies, countries, and industry sectors, played multiple different roles, all being a practitioner myself. I have dirtied my hands myself before turning into a trainer and consultant, roughly 15 years or so. I won awards nationally, globally, multiple times. Authored 10 books also. If you look at the topic, the discussions around this started because of the global financial crisis a decade, little more than that ago. Then BCBS recognized more work was to be done in the area of operational risk management. So BCBS recognized operational risk as a distinct class of risk in 2001. What is operational risk? We'll just see in a few seconds. Then COVID-19 pandemic increased the focus on third parties as well. Incidents of cyber attacks increased at the same time. And this is not one company, one country. All this has been happening across globe. Then BCBS published updated principles for the sound management of operational risk in 2021. An effective operational risk management system and a robust level of operational resilience work together. So right from the beginning, we start getting a sense that we need to be resilient in our operations, which we will get through managing our operational risks effectively. So these two work together, ORM and OR, to reduce the frequency and the impact of operational risk events. A very meaningful statement. Second portion also. The basic principle of risk management tells us that risk is inevitable. So the attempt intention is not to remove all risks. We cannot. No one, no organizations can do that. So the intention is to reduce the frequency, and even if it happens, then the impact also controlled. So a lot has been happening because of this intention. A lot has been happening in the financial industry around the globe. While the session is towards financial institutions in Malaysia and nearby countries, but the concepts are equally applicable for all industries in all countries. So even if there is no regulator in some industry sector in some country, or if regulator exists, but they have not mandated operational risk management and operational resilience yet, the right time is to do it now, start it now. Anything that we want in future, assume the business strategy is for 3 or 5 years. For 2025, we would have developed for 2030, 5 years strategy. The time to work on operational resilience and operational risk management is now. Quickly look at the definitions. Two topics we are going to be touching upon in this masterclass. Operational risk has been defined as the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. I will share some sample examples of operational risks also in a while. And if you look at operational resilience, it has been defined as the ability of an organization to deliver critical operations through disruption. Once again, very important. While it's very simple, not even a full sentence, it's a phrase, but it's very meaningful, deep meaning in this. Ability to do what? To deliver only critical operations. This is very important. This makes us reasonable and practicable. Otherwise, organizations may end up spending unlimited amount on operational risks and or operational resilience. So the expectation itself is not to do all during disruptions, but to do the basic, minimum, essential, critical, time sensitive. There are different terms that we use. And also when we say through disruption, it tells that we all are admitting that disruptions can, may, will happen. No one is fail-proof or foolproof in this world. I also invite your attention to this short video. I'll play it and pause to check whether the audio video both are clear. Can you see the video?
Yes.
And the audio clear?
Clear, yes.
Very good. Sorry about that. Operational risk management, or ORM, is a continual cyclic process which includes risk assessment, risk decision making, and implementation of risk controls. This results in acceptance, mitigation, or avoidance of risk. We can also say that ORM is the oversight of operational risk, which includes the risk of loss resulting from inadequate or failed internal processes and systems, human factors, or external events. As I said earlier, a risk is inevitable. No one, no company, no individual in the world is or can be fail-proof or foolproof. So we need to be prepared to the extent possible. There is a concept of too good to fail. Too good to fail. In the past, we used to have a term called it's too good to believe, which would mean it is so good that it cannot be true. So, too good to fail, too big to fail means it's such a big organization that it cannot fail. And that's wrong impression. There have been so many cases in so many countries where even the biggest ones have failed. Failed to the extent of just being vanished from the scene. Not only just having some disasters, some crises, all organizations have. So we need to be prepared. That's what the intention of operational risk management and operational resilience is. Too big to fail is a wrong impression that we may carry. Let's quickly look at some examples and cases of operational risk. Operation cyber attacks have been happening, can happen to anyone. So this is the first interaction. Please move your fingers in the chat box. Anyone who believes that cyber attack cannot happen to his or her organization. I'm looking at the chat box. Or let me change the question. Can a cyber attack happen to you, your organization? Say yes, no, please, in the chat box. Can happen. Thank you very much. There are some. This is the latest trend also, which is a negative trend. Agreed. Thank you very much. And this is how I'm going to narrate about 6, 7, 8 cases, but with each case, the question is same to you all. Can this happen to your organization? Keep checking. I'm looking for no's more than yeses. Anyone who says it cannot happen to his or her organization, then I'll be more interested in discussing. We can make mistakes. People can make mistakes. And that gives rise to an operational risk. Regulations are not risk. Regulations are not bad. But if I'm not compliant to regulations, that becomes a risk, an operational risk to my company. Similarly, outsourcing is not bad. Almost all of your organizations would have done some outsourcing. It's required, it's need of the hour, need of the day. There are benefits of outsourcing, but with outsourcing comes some risks also. First is that we become dependent on someone else. And second is that we have less control over those activities that have been outsourced. This outsourcing, we think of vendors, we think of third parties, which is a big area and a big gap across globe, in my knowledge, having gone across companies, countries, industry sectors in different roles, including as an auditor also. And that's why we decided to have a course around third-party risk management specifically. We'll talk about that tomorrow's masterclass. Talent management, which starts from recruitment, retention, and then detention or deletion or removal also, was always a risk or a challenge for all companies. This still continues. If you think of last 4 or 5 years, a lot changed in this space because of or during COVID-19 pandemic. The recent trend in some companies, and some companies are biggest ones in the world, in some countries, is because of some technology, which is AI, the artificial intelligence, said to be, I wouldn't say there are any proofs yet, is resulting into loss of jobs. So that talent retention is a challenge. Can give rise to our operational risk, one of the operational risks. We all organizations are highly dependent on IT. So any disruption in IT, which could be of so many different types. Network may be down, server may be down, and maybe down due to various reasons. It could be flood, fire, earthquake, power loss, etc., cyber attack, etc. So digital disruption, IT implementation may go hand in hand, similar. Every second, huge amount of data is being generated by all the companies in the world, all financial institutions also. So they have got this as an asset. They store this data, collect this data, analyze this data to make improvements in their products and services, or to launch new products and services. So if there is any loss in this data, or the capability of analyzing the huge amount of data that all the financial institutions have, all other institutions have, that will give rise to operational risk in that company or organization. Cyber frauds have been happening, cyber attacks have been happening, data leakage, data corruption, data center failures have been happening. So these 4, 5 may be clubbed into one also if someone wants, but for the ease, it's good to think of these separately also. I hope you have been answering that question for yourself, whether this can happen in your company. And I'm repeating, I'm looking for no's more than the yeses. Change is not bad once again. And there's a saying that the only constant in the world, in the life, is change. But some companies, some organizations change at a very high speed, which may not be in line with the culture of the organization. And then it may become the change in the organization may become a risk, an operational risk. And the last one I'm saying is processes. And once again, processes are not bad. The challenge is that we don't maintain these processes up to date. The way I work in a bank, for example, or in any financial institution might have changed. I might have done some tweaks in my operations, in my way of working to increase my efficiency, quality as well as quantity of my work. But perhaps I wouldn't have updated the process. And that's what most organizations miss. So the day the money is not available due to any reason, has retired or has gone to a competitor or has passed away, huge dependency. The new person picks up the process is out of sync. And that may give rise to operational risk. I'm pausing for a second, looking at the chat box, especially if anyone says, Daman, this cannot happen to my organization, or say, all these can happen in my organization. Can happen, perhaps you can type in that much only. Can happen, cannot happen. First response is can happen, all of these. Cannot happen is my interest. Thank you very much. And whether you respond or not, for whatever reason, whichever may be your country, industry sector, whatever job you may be doing in your organization, trust me, all these are possible. Because nothing is impossible in this world. By definition, a risk can, may, and will happen. It's only the matter of time and the amount of impact, severity. Now I'll pick up cases quickly. Looking at the time also, roughly 50% gone. Data entry error. And again, with these cases also, please keep answering that question, whether this can happen in your company. The cases, the names that I've picked up are fictitious, but the concept is real. So MIB has Ali as a data entry operator. While entering a new insurance application, he mistakenly recorded the applicant's monthly salary as RM 1,000, 1 million instead of RM 10,000. So do not look at the company name. Do not look at the amounts. Look at the event. Event is a mistake by someone. Can this happen in your company? Keep answering the question. If this has happened in MIB, the implications can be very serious. It is possible that a policy gets issued to this person incorrectly, which means on incorrect terms and conditions, and most likely assume the amount of insurance is huge. And if this person dies, assuming this is life insurance policy we are talking about, this claim would be due to his family or her family. At this time, surely company will catch the mistake happened at their end and would not like to make the payment. This may create big challenges for the company. Going up to the court, legal cases, also losing reputation usually, and if they make payment, then the huge financial loss also because of one human error, one operational risk. Second case is about technical system failure. So immediately here itself, you can say yes, no, can happen, cannot happen. At least keep writing on your pads in your mind. Lisa, an IT analyst at Maybank, develops an application for the finance department to process vendor payments. At the end of the month, actual cash outflows exceed system-generated figures. This is a mistake, very clear. Some risk has occurred, has happened, event has taken place. So investigations reveal that certain payable amounts were duplicated during processing. A coding error or an error or a bug in the code in the program. What happens is a lot is disturbed. Amount may be small, which has not been mentioned in the case. It could be big also. But reconciliation doesn't happen. There will be some hard ones. There will be questions, counter questions, sometimes blame game. The company may lose reputation also, and including the regulator, if it's a financial institution specifically. Almost all countries have a regulator in the financial sector. There is a central bank in all countries who is the regulator. They may have questions, they may have audits, and they may ultimately, the worst case scenario for any financial institution is that their license to operate is cancelled by the regulator. Now, exercise once again, typing. What does this appear to be? What do you think is coming up in this case? In the chat box, please. I am monitoring. What does this appear to be? Case 3. This appears that someone is maintaining his or her accounts manually. There are some activities, heads, and there are debit and credit entries. Okay. Who is that person? Siti maintains personal financial records as above and expects her saving accounts at CIMB to have RM 120,000. But she receives a message from the bank that the amount balance in her account is 100,000 only. So once again, oh my God, the bank has eaten up my money. Hard-burn to a person. So personal resilience also comes into picture. But she later realizes she forgot to account for RM 20,000 entry. That is, she annually donates some amount, the card donation of 20,000. At this point, then, I would like to talk of what we have done in three cases. We identified a risk. But risk management, so operational risk management, identification is only the first step. So maybe 33% of the work done. After that, we need to do the mitigation also. Before which we need to do the evaluation also. Over a period, a big topic to be discussed is the effectiveness of the control, the mitigation that we might have put in place. Many companies do not do that. Even in our personal lives, we do not do that. So my request suggestion is please get connected with me on LinkedIn. Look into the blogs that I have been writing, 2, 3 every month. Around 50 are already available. One of those blogs you will find about this, the effectiveness of the control, which once again in financial institutions, within operational risk management, within operational resilience is a big area to be taken care of. Case 4 is, once again, it seems some person is involved here, not machine. Ahmad, a junior risk officer at RSV Bank, mistakenly approves a high risk loan application without verifying the customer's creditworthiness. Mistake, possible, can happen. Not easy because we would have processes, we would have maker, checker, etc., in all organizations, almost all banks, financial institutions. But there is a possibility of mistakes somehow. Sometimes it may be on purpose. Some people would do this knowingly. And the moment I say this, another big area in risk management is insider risk management. We, the employees of the organization, are the biggest insider risks. So I could be doing this knowingly also, on purpose also. So we need to find and then fix. So assume it's me, it's not Ahmed. Throw the one out. That's the mitigation. According to me, is not right. The one made this mistake unknowingly. Perhaps he was not trained enough. So we need to find the root cause, as we keep saying in management systems. And that cause needs to be fixed, not the person who made the mistake, not the man. Or even if the man did this knowingly, why did the man do this? We need to find the reason and fix that reason also. Just removing the man is not the right mitigation. So in risk management, we need to identify, evaluate, mitigate, and then over time, we need to keep checking the effectiveness of that mitigation, of that control also, especially in financial sector. Online banking, some organization, a critical server failure at Bank Islam Malaysia leads to a 4-hour online banking outage. Can happen. Someone say, no, please, Daman, in my company, this cannot happen. In my bank, it cannot happen. I'll be happy to meet that person. So if this happens, what is the result? Customers may not be able to transfer funds or pay bills. So customer dissatisfaction is first outcome or impact. And they may be financial loss, they may be reputational loss also. The customers may lose lose trust, faith in the bank, and ultimately may start going to competitors. That's the biggest loss that could happen to Bank Islam Malaysia. And I'm repeating, in all these cases, the names, people, or the companies are fictitious. Concepts are the real. So pay more attention to the concepts. If you look at this one, Bursa Malaysia's settlement system is designed for normal trading volumes, whether it is 1,000 transactions per day or 1 million transactions per day, whatever is normal for them. Their systems are designed for that. But during a market crash, can this happen in Malaysia? Someone said, no, please. During a market crash, trade volumes surge 50 times higher than usual, causing settlement delays due to manual processes. So they have BCM in place. If system fails, we will do manual work. While this is highly theoretical according to me, but still believing whatever is said in the bank, by the bank or by the company. Manual work will be done, but that's not enough. So, what is the fix? Manual work is or should be the last priority or least priority. We should first attempt the systems do not fail. So, resilience in the systems. But even if those fail, then we have a backup. So, if it's IT, for example, an alternate IT. And then when we go deep into that, we'll have to see that there are safe separation distances also. Then we talk of some terms called recovery time objective, recovery point objectives, etc. All those also need to be considered and taken care of. AM Bank mistakenly refuses to refund fee to credit card customers who were overcharged due to a system glitch. So first mistake, there is a system glitch. Second is when they are refusing, it is possible that it's a person's mistake. But today, a lot of automation is happening in all banks, all institutions, including some such decisions may be taken by AI also. And AI can make mistake, as simple as that. So it is possible to have double technology glitch in this case. Frustrated customers escalate complaints to the central bank. Again, the impacts, frustration of customers may take them away from the bank. The bank may lose, first of all, reputation, and maybe a penalty or penalties, multiple penalties by the central bank. And quickly, when we talk of the penalties, in some cases, such penalties for such failures by the central banks, by the regulators are huge. These could be millions and millions, whichever currency we want to use, whether the local in Malaysia or the universal to USD or the GBP. Huge penalties are placed. Prudential Malaysia, so it's an insurance company as you, offers a cooling off period for life insurance policies. So the one you have purchased a policy, you have 15 days, the cooling off period. If you want to return, you can return if you're unhappy, dissatisfied due to any reason. And they estimate 1% cancellation rate. But they experience 5%. So 1% was within their risk appetite. They had provisions to take care of that much loss, money being returned to the customers. But it happened to be 5%, which means 500%. Huge loss. Amount may be loss, it's small, but the degree that it's 5 times, that is huge. And it may upset the policies, business strategies, etc., etc. The whole budget may be disturbed. An important case, according to me, Kevin is a finance officer at Public Bank and is suspected of fraudulent transactions. You are aware. So you both are colleagues in the same bank, same company, same organization, same institution. You know this, that Kevin is doing something wrong, but you hesitate to report it and you don't report it. I want to stop once again. Exercise, move fingers, please, in the chat box. What could be the reason that you know Kevin, or assume me, Daman, is making a mistake? Financial fraud. You know it, but you don't report or you don't escalate. What could be the reason? In the chat box, please, quickly. Anyone? And that is the biggest risk, by the way, in the world. that people don't speak. We know there is a risk, whatever it may be, flood, fire, earthquake, ethical, fraud. We know, but we don't speak. That's the biggest risk. One case coming up towards that also. So a response from Shyam is compliance risk, integrity risk. No, I'm not asking what type of risk this is. I was asking why would you not report? I'll tell you the reasons with the case 10. Case 10 is workplace misconduct. A senior investment banker at Hong Leong Bank is observed harassing a junior colleague. Witnesses do not report. So many people have seen this. A senior person is harassing a junior person, but they don't report. What could happen because of this? I'm not spending time on this now. In these two cases, I want to know if you were that person, why would you not report? Because that's the biggest risk. People don't report. And by the way, people are your biggest antennas also. Always pay focus attention on people and always take care of people. Whether you are doing operational risk management or operational resilience, people are most important. And the reason is because I do not report it. Let me take myself rather than you. You become the person, sorry, someone else is doing the fraud or misconduct. I do not report because that person may be my senior. So I'm hesitant. Before that, none of my business. I'm not impacted. Someone is doing, someone is losing. Why should I bother? I'm busy in my job. I'm happy getting my salary, etc., etc. We have that attitude also. If not all people, then some, many in almost all organizations. And that comes to culture of the organization also. In risk management, operational resilience, we need to pay attention to the culture of the organization. We need to develop a culture of risk management in the company. It's not easy. It takes a lot of time to develop culture or make a change in the culture. So I do not report because I think my attitude is none of my business. Second is the person doing may be senior to me. Third is the person doing may be my close friend. So if I tell about him or her, I will lose. A close friend, I don't want to do. So what do we do then? How to fix such places, such things? Actually, this diagram is the answer. This picture is the answer for case 9 and 10 specifically. When you know, but you don't report, whatever type of risk it may be. The whistleblower policy is the way out. That's why whistleblower policies have been created, processes have been created in the world. And again, if we look at the recent happenings, we know there have been some cases that came out. Whistleblowers did their job. But again, we need to see whether that policy, whether that process is working and working effectively or not. That's the effectiveness of the controls. Brings us to the last case that I wanted to discuss this afternoon. At FN Bank, an internal audit reveals that no risk incidents were reported for 6 months. Which organization is this in Malaysia? I would like to go and salute them. So does this indicate a risk-free environment? Are they risk-full? Risk-fool-proof? Risk-fail-proof? No one can be. Or is it a culture of under-reporting? Actually, it is the culture of under-reporting, which I was just discussing. The biggest risk, according to me, is not the risk, but the risk of people not reporting it, not logging it, not bringing it to the knowledge. A calm sea is not necessarily a good sign, according to me. A zero recorded is the audit finding is zero were reported. This does not mean zero happened. This may mean that people are not comfortable reporting. They don't know how to report. They don't know what happens after reporting. They may be worried, scared that there may be something wrong against some action against them also. That's why they don't. And actually, this is a big failure for the board, I would say, that their people do not have faith in them or in their tools, technology, or processes. Big one. That's why I wanted to close with this and also invite you to read one of my blogs. I'm waiting here for a minute if you want to take a picture, or otherwise, we will share the recording with you all. Quickly, the one more, I said 11, but perhaps 12. Remote working employee at Standard Chartered Malaysia is bribed to share some. When we are working from home, there is less control. So while the whole world now, because of COVID-19 pandemic, during those 2, 3 years, almost all of us work from home. But I'm very sure that both parties, the customer as well as the vendor, closed eyes to some risks. There are many, huge, multiple risks of working from home. I conducted a global study. Once again, the report is freely available from my website. If you want to download, read it, please. Work from home should be only BC solution, the last resort, because it's not safe. Some other day, I'll come back and devote one full hour just to work from home. When we say work from home, means remote work or working from anywhere, the different terms that we have been using. Repeating the definition because the second one, operational risk management, is a little longer now. Entire gamut of activities, right from risk identification, measurement and assessment, monitoring and control, mitigation, reporting to senior management and the board of directors. This is specific to now financial institutions, to some of the mandates, rules, regulations in the world, but otherwise any company will have board of directors. So we can make it generic also. On the organization's risk exposures, business continuity management, and learning through feedback for improvement. So in this definition, I see PDCA cycle also, which is plan, do, check, and act cycle of continual improvement. There's a concept called 3 pillars approach. We see the 3 pillars: prepare and protect, build resilience, and learn and adapt. So continual learning is required. Today, I just wanted to show this. This is how, I will say this is house of operational risk management or operational resilience. At the top is the roof and it's standing on 3 pillars. We see continual improvement, third pillar, but we see business continuity. We see TPRM, third party risk management, incident management, ICT in the middle column. And the first one, which helps us to create a base foundation. Governance and risk culture, I talked about that quickly. Responsibilities of boards, there was a case around that. Risk management, which is the basic we are talking of. Operational risk and operational resilience. Total 3 pillars is operational resilience approach of a company. This is what is expected in the world, by the regulators, etc. BCBS defines operational resilience as the ability of a bank to deliver critical operations through disruptions. Easy, simple, I'm repeating. Also, just change bank by an organization or company. And this definition is applicable to all companies, all industry sectors in the world. Resilience, operational resilience is the ability of a company to deliver critical operations through disruptions. I like it very much. Simple, straightforward. But if you look at Gartner definition, they have defined this as initiatives that expand business continuity management programs to focus on the impacts, connected risk appetite, and tolerance levels for disruption of product or service delivery to internal and external stakeholders. The third one I'm picking up is from Protiviti. Again, a consulting company. It's not as big as Gartner, so maybe you haven't heard the name. So, company is not important. Look at the definition. They define operational resilience as an organization's ability to detect, prevent, respond to, recover, and learn from operational disruptions that may impact delivery of important business and economic functions or underlying business services. So once again, I see that PDCA cycle, plan, do, check, and act cycle of continuous improvement in this definition, and that's why I have picked up. ECBS as well as RBI, Reserve Bank of India, the regulator for the financial sector in the country, they say operational resilience is an outcome that benefits from the effective management of operational risk. So, to achieve operational resilience or to be resilient in our operations, we must pay attention to operational risks. We should manage operational risks effectively. So BCBS has principles for operational resilience. Bank of England has mandate. European Commission's proposed legislation in digital operational resilience, so it's famous as DORA. Central Bank of Ireland, they have issued something. Reserve Bank of India in India has issued something. Federal Reserve Board's sound practices to strengthen operational resilience. I have studied about 20 such mandates, guidelines from 20 different countries. So there's a lot happening in the area of operational resilience, and due to which a lot happening in the area of third-party risk management also. Culture is important. People make culture. It takes long to build a culture or long to even make a little change, even if it's a little change required to be in the culture of the organization. So companies, boards, top management has to spend a lot of time, money, and effort on developing the culture of risk management. And which, fifth time I'm repeating, the biggest change would be that people feel encouraged, happy, comfortable in reporting the risks or incidents. So there is some role of governance, there is some role of board, there is some role of senior management. There will be risk committees of different types, names, sizes in different companies, depending upon the size, nature of the business. Internal audit is very important, and regulatory compliance. All of these put together will make some change in our risk culture. Or if you want to make a change in our risk culture, either all of these or one or two of these will become our focus. This is how we'll have to tackle the problem. Establish a code of conduct. Almost all companies will have. If not, then immediately, please. Ethics policy, applicable to both staff and board members. So from junior most to the senior most person, everyone has to follow the code of conduct and ethics. Clear expectations for integrity and ethical values of the highest standard. Identify acceptable business practices. What is acceptable, what is not. Anti-bribery, anti-money laundering. There are so many different ways of tackling these. And it's not either or, it's all and. Prohibit conflicts of interest or the inappropriate provision of financial services, regularly reviewed and approved by board, which means monitoring and reporting comes into picture. Attested by employees, available publicly, and implementation overseen by senior ethics committee. Some examples that a bank's board of directors establishes a risk committee responsible for reviewing the bank's ORM, Operational Risk Management Framework, including policies, procedures, and key risk indicators. A manufacturing company conducts regular risk assessments and reports findings to senior management, who then develop action plans to address identified risk. And the third example that I put here is an Energy utility undergoes annual audits by internal and external auditors to evaluate the effectiveness of its ORM processes and controls. So once you have put the process in place, the next level is that you look into the effectiveness of the same. Quick look at what is board expected to do. In operational risk management and operational resilience, establish a risk management culture. Ensure that the operational risk management processes are subject to comprehensive and dynamic oversight. It's a regular process, not one-time process. Provide senior management with clear guidance regarding the principles underlying ORMF, Operational Risk Management Framework. Approve policies developed by senior management. So it's clear policies will be developed by the senior management, but will be approved by the board. There is no way out. Regularly review and evaluate the effectiveness of the ORMF. Ensure independent review of ORMF by a third line of defense. So there is a concept of 3 lines of defense. Big area once again in operational risk management and operational resilience. Establish management responsibility and accountability for implementing a strong control environment. Ensure effective risk management policies and practices are in place to manage third-party risks, TPRM, we call it in short. Take active role in understanding operational resilience approach and communicate its objectives to all relevant parties, including the staff, third parties, and intra-group entities, if there are intra-group entities also. Coming towards closure of this master class this afternoon, I also wanted to spend some time on drivers. Why should we do this, Daman? That be a big question. And there are multiple answers. The big why. Why should we do this? Regulatory requirements exist. Corporate governance exists. There are implications of non-compliance. And there are gains through compliance and that journey. I've drawn a path, copyrighted to me. I'll be happy to share. So Bank of England, this is one example only. In one country, the regulator has done this. But almost all countries, all regulators, especially in financial sector, have done this. Even if I do not have a regulator, even if the regulator has not asked, not mandated this yet, it's good to be good. So from corporate governance angle, you may like to do this. Penalties, some cases known to the extent of, I'm saying 250 billion pounds minimum. And there are some other cases available, $243 billion, $180 billion, $185 million. And I'll share the sources also. But if you do it right, the compliance to the regulations, it is expected in large organizations, they may be saving off about $700 per person per year. In smaller organizations, it will be much bigger, up to 3 times more. And this is the path that I have drawn, I'm saying. Journey from risk management to organizational resilience. That's what all organizations should attempt. It's a long journey. But let's start and continue. So from risk management to ERM, Daman, we have done both. Many hands will go up. Very good. Keep it up. It's not either or. Keep doing these. Keep improving these and also move to GRC. Daman, we have done that also. BCM, Business Continuity Management. Daman, we have done that also. Then move to operational resilience, please. Achieve excellence in your operations and then achieve organizational resilience. And I'm repeating, this is not end point. There will be some gaps. No one is perfect in this world. So we'll have to continue on this journey forever. And repeating from risk on the left hand to organizational resilience at the right hand, it's a long journey. Let it be a planned journey in your organization. What has been happening in Malaysia quickly? The paper on operational risk. I hope you can see it easily available. If you don't find, please ask us. We will share this with you. Intention here is not to read it. Intention is here to let you know. I hope you could see it. Someone say yes, no, please.
Yes.
Great, thank you. And also BNM BC policy. I hope you can see that also. So the central bank itself has business quality management. As of now, I'll spend few seconds your attention only on the table of content. What is there? Look at part B, please. Critical business functions, risk assessment, business impact analysis. All this is BCM portion. Crisis communication, interdependencies, alternate site testing and exercise. Roughly whatever any company does anywhere in the world when it comes to BCM. That is what the bank is doing. So bank will expect you all also to do the same. While finishing quickly, my apologies, we have gone past 2, but maybe 3-4 minutes more. What's coming up, as one had said in the beginning, a 3 days course. Today was just a glimpse in this masterclass. The course is called Certified Operational Risk Management and Operational Resilience Specialist for Financial Institutions. So it's a specialist level course, 3 days course. Quickly sharing with you the key features. It's 3 days duration, 100% HRD Corp approved, and one can make any corrections if I'm making any mistake here. It's CPD UK approved course, designed, developed, and delivered by certified international trainer Professor Daman Devsood myself. I will be delivering that course also. Before that, the development design also is by me. Dates are 20th to 22nd August, and this will be in person. Unlike today's masterclass, I will be traveling to Malaysia, and I look forward to seeing you all soon. Few more features. The course provides you 24 CPD credits. Certificate is by FIK and DVD Training and Consultancy. And second, so double certificate by CPD UK. After clearing this course certification, you will be able to use this title with your name, specialist for this area. This is highly interactive course. This is how I have built AI-enabled learning. So we'll touch upon that also, which is a risk, which is a benefit, which is a boon, which is a bane both. But we'll discuss this during the course. As many as 20 exercises in just 3 days, 8 quizzes, 3 world-class case studies. On top of that, all 3 days full of discussions, examples, and questions. I will ask and you will ask and we will resolve the challenges together. Tons of additional reading material before and after the course. Personally signed book free. My book, one of my books. I'll sign it there and will present to you all. And live support. You can write mails to me anytime. All mails are responded within 24 hours. At this time, I would like to launch a poll also, which is the last question from my side. And my apologies, I'm not able to see that option. Great. I hope you can see the poll on your screens. Please do respond. Here there are 3 options. Question is as simple as that. Were these discussions useful? You have 3 options. I'll wait for a few seconds. Thank you very much. We'll take note of your responses. This is where I would like to stop in this master class. But if you have any questions, I'm here. Any questions now or later, you can write to FIK through Wanan or to me directly. We'll be happy to respond to all questions. I look forward to seeing you all. Tomorrow also there is a masterclass which is on third-party risk management. You may like to attend that yourself free, or you may like to promote this to your colleagues also. You may like to encourage your colleagues also. Stopping here. If there are any questions, happy to take questions also. And if there are not questions, any questions coming up again, I would like to hand it back to Warren to say if you, there is question, you may contact me. Yeah, Warren writing, right? So anyone, as I'm saying, I said, please feel free to write two questions to us after the session also, after the masterclass also. All questions will be answered. That's guaranteed. Thank you very much.
Professor.
Yes, please.
Yeah, Professor, thank you. Thank you very much for the time and for the input that you have shared with us. And also to the participants who have given some, responded to your question using the chat box. So thank you all. And I've given you my detail there from FIK Kuala Lumpur. We are based in Desa Pandan, not too far from most of the financial institutions here. And tomorrow there's a session, also third-party risk management, same time, same platform, Zoom. So looking forward to meeting you all again. So once again, thank you. And Professor, thank you for your time.
Thank you very
and your
much.
input.
All the best. Bye-bye.
Okay. Thank you. Take care.
As a host, I'll wait for some time before everyone has logged out, and then I'll log out myself. This is just a gesture of respect. Me being the host, I'm waiting for guests to leave before me. So once again, Wanan, thank you very much. And
Yes,
I guess we close the session now. Right?
Yes, we can
Right.
close,
Bye-bye.
Doctor.
And see you
Okay,
tomorrow
thank you,
once
Professor.
again. Same
Tomorrow.
time. Thank you.
Take care.
Bye-bye.
Bye-bye. Right.